studio tonight, Richard Rosso, Certified Financial Planner. We've also got Danny Ratliff, Certified Financial Planner, and John Camarianos, our in-house Wall Street analyst, a Morningstar analyst, as well as a journalist extraordinaire. In fact, John, I need a bit of validation here. Yesterday, when the market was selling off, we were down like 18, 19 points a day. I said, don't worry about it. We're going to bounce back tomorrow.
Sure enough.
There we go. I called it.
One day call.
And that's the way it's been lately. If you're watching our live stream on our website right now at realinvestmentadvice.com, or simply go by our Facebook page, Real Investment Advice, you can see our live stream. But this is the way it's been as of late. The market has been just really stuck, again, just in this big, broad trading range. We were unable to get out of that trading range today, although we're right at the top of it. But again, today's action was interesting. Yesterday, as we said, there was a big concern over the tariffs that the Trump administration launched against China. That weighed on stocks yesterday. We actually gave up a big bulk of the previous day's gains. And then today, because China didn't immediately retaliate, well, apparently trade war's over and we won. I'd be very careful with that assumption right now, because I would suspect that over the weekend we're probably going to see some comments from China about trade and tariffs. We're also seeing some other implications in the economy already from tariffs as well. But the one thing here, importantly, is that we are moving into earnings season. Now, tomorrow we've got big banks reporting, JP Morgan, Wells Fargo, Citicorp, a couple others. Banks have not been participating in this rally at all. In fact, despite the fact that they're getting better net interest operating margins on their deposits because of the Fed hiking interest rates, and they're not passing that interest rate hike on to lenders as much, or to borrow as much. But what we're also seeing is the yield spread is really starting to weigh on these banks as well. So they have not really been performing well. JP Morgan, Goldman Sachs, all these big major money center banks have really been lagging the recent rally. So we'll see tomorrow what their earnings look like, but a disappointment there in that sector could weigh on the markets tomorrow. And really, when you look at the breadth of today's rallies, it is, this has been one of kind of the key concerns as of late of this entire market rally this year, is that basically about 10 stocks have made up the entire rally this year so far. And today was a big example of that. Facebook, Amazon, Microsoft, Google, those were those stocks, and because they're so large in terms of their market capitalization, and particularly in the market capitalization weighted indexes, lifts the whole index. So you get this move higher in the index. But really, when you look at the breadth of the rally across the entire spectrum, it really was not that great of an internal rally today. In fact, there was a lot of laggards. Oil prices actually broke $70 a barrel this morning. We were down at $69 a barrel this morning. We're seeing weakness in commodities. And at the same time, they're seeing weakness in commodities, which is an economic concern, right? Because commodities are a reflection of demand in the economy. So when you see things like copper breaking down, when you see things like oil prices declining, it suggests that there may be some weakness in the economy. And one of the things they call copper is they call it Dr. Copper, because copper's in everything. We use copper in everything from wiring to just about anything that you utilize. At some machinery, your car, everything, your phone, all has copper in it. So copper is very economically sensitive to demand. And then, of course, oil prices and energy prices also a big part of the economy, because it's in everything that we use and consume and pay for. So those two areas in particular have been showing some weaknesses of late. And that's going to weigh on two things in the economy. First, it's going to potentially weigh on the economy as a whole. But secondly, is that it's going to drag on inflation. And in fact, we had the decline in oil prices last month. We bounced back from that decline, but what we saw today was because of that drop in oil prices last month, we actually had a weaker than expected inflation report today, which also gave some support to bond prices. And again, this is the other kind of conundrum here. If the market is doing so well, and again, you keep this in mind, if stocks are doing really well, then people are taking on a lot of risk, and you've got a big, broad rally, then money should be coming out of areas of safety, which are particularly like bonds and utility stocks, etc. And we're not seeing that. In fact, bond prices have now moved back above their 200-day moving average. We're back in a bullish trend in bond prices, and despite the fact that we had this big rally in stocks today. Bond prices actually held up very, very well, ended flat for the day, but we've had this big rally, and now you've got the 50-day crossing up. It's now heading back towards the 200-day, and there's a real possibility here, again, going back to the whole story behind oil prices and copper and the other stuff that's happening in the economy, that if we do get into a situation, and particularly with a trade war, et cetera, and if this thing continues to accelerate, the rising tariffs are going to weigh on potentially economic growth. And this really feeds into the thesis that we've been talking about here for a long time, is that when the next recession occurs, interest rates are going to zero. And that's just a function of going to be the rotation to safety, and particularly when you look at what's happening with junk bond spreads, high yield bonds, corporate leverage. Those things are at levels that have historically always led to very, very bad outcomes. Now, the problem is you don't know what the catalyst is going to be that's going to cause it. But whenever you get that catalyst, it tends to happen very quick. You have a big unwinding of this risk very quickly. And right now, no matter where you look at inside the market, we have layer upon layer of risk, whether it's money has been piling into very crowded trades on shorting U.S. Treasuries. We've got a record short position on U.S. Treasuries, despite the fact that bond prices have been rising. So as bond prices have been rising, people are shorting the Treasury more and more, expecting we're going to have this big resurgence in economic growth and this strong rise in inflation. If they're wrong and you get a reversal in that short position, bond prices are going to fall. Rise very quickly as interest rates fall very, very quickly when that occurs, because there's going to be a massive move to cover those short bond positions. Then you take a look at the amount of money that's piled into corporate high yield debt. Now remember, high yield debt is not just a function of something paying you more money. High yield is the marketing name for junk bonds. That's going to be an area, when that area cracks, and it will when we have the next recession, that's where a lot of money gets lost very quickly through high yield debt. So again, really, when you look through the entirety of the macro complex of the markets, there is a ton of risk in the markets that people are simply just ignoring at this point, because the markets have just maintained this very sideways trend as of late, and it really doesn't look like much can disturb the markets. And no matter what comes out, whether it's tariffs or geopolitical risk or NATO or Russia or Iran, it doesn't really seem to affect the market, and people just kind of keep their assets in the market. Interestingly enough, we talked about in last weekend's newsletter that sentiment, how we feel about the market, has actually declined. People are becoming more fearful about the market in the short term. Now, not to a great degree, but a little bit. So the really rosy, optimistic scenario that people were believing in for 2018 is starting to taper off a bit. Not surprising after this market we've had this year. But despite the fact that they're becoming more fearful, they're still more allocated to equity risk than at any other point going all the way back to 1999. So in other words, while they're more fearful or more concerned about the market, they're not doing anything about it because they're fearful of missing out on the rally. For us, we're not so much worried about missing out on the rally as we are fearful about losing money. So that's why we focus on risk, capital preservation, and again, if that's something you need to be concerned with your portfolio, go by the website, realinvestmentadvice.com, send us an email, schedule an appointment with myself, Richard, Danny. We'd be more than happy to sit down with you, John, and talk about risk in your portfolio, what we can do to hedge it, maximize it, and make sure that you preserve your capital for retirement. We'll take a quick break. We'll come back. Get by the website, realinvestmentadvice.com. You're listening to the Real Investment Hour right here on the Voice of Texas. Don't go away.
Lance Roberts' blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.